Hello everyone, welcome back. We'll continue with inheritance tax and I will share the screen with you so that we can quickly finish our remaining bits and pieces for our inheritance tax. Bear with me 1 second. We've done the related property. Now we'll have to do the quoted shares and securities. Now, in order to calculate the quoted shares value, it is exactly the same way like we do for capital gains tax, except for the small difference as you can see on your screen. So we'll have to take the lower of these two. So lower quoted price plus 1/4 of the difference between higher quoted price and the lower quoted price. So it is 1/4 of the difference between higher quoted price and the lower quoted price. If you remember from capital gains tax, it was 1/2 of the difference between higher quoted price and the lower quoted price. Whereas in inheritance tax, it is 1/4, right? So that is the only difference. And the remaining one is going to be average of highest marked bargain and the lowest marked bargain. So it is basically average of the marked bargain. So whichever is lower of these two, you'll have to use that one. For unquoted price, it will be given to you in the question anyway. And unit trust, you will have to choose the lower price of the two published price. So basically it is called manager's bid price. Two published price will be given to you in the question. For unit trusts, you'll have to use the lower of these two, right? Then it says life assurance policies. So if, say for example, Mr. A had a life assurance policy which matures on his own death, we'll have to include that in his death estate. Whereas if Mr. A had insurance which matures on someone else's death, then we'll have to take the proportionate method. Now, as you can see on your screen, where a person's estate include a life policy which matures on his death, the proceeds payable to the personal representative must be included in his estate for IHT purposes. But where a person's estate includes a life policy which matures on death of someone else, then the open market value will be used in order to calculate the value of the estate, so which will be given to you in the exam anyway. Right? Now, when it says matures on someone's death, it means that when someone dies, then the insurance company have to pay some amount to the whoever the representative is, right? So it's called maturity, right? So maturity of the insurance. Right, then after that it says overseas property. So overseas property basically is exactly the same way like we've done earlier in the property valuation. So you'll have to deduct the overseas debts against the overseas income. You'll have to deduct that. And another thing is that 5% of the expenses of the maintenance of the property or the selling of the property is also deductible. That's what it says in beneath that. So the maximum we can deduct is up to the 5%. So it says if the property passes on death, the cost of the administering and realizing overseas property are deductible up to the maximum of 5% of the gross value of the property. Right? So what does it mean? It simply means that if you have a property overseas, if say for example I am living in London, but I have a property in France, so in order to sell that property, there will be some expenses. I'll have to pay solicitor, I will have to pay administrator, and I might have to pay taxes as well. So all of these expenses can be deducted up to 5% of the value, right, for IHT purposes in the UK. The next thing is business property relief and agricultural property relief. We will leave these two for now, and we'll come back to it later. Let's look at the death estate, death estate pro forma on page 71 of your lecture notes. Excuse me. Now the death estate which I showed you in the earlier lecture, I made a little table. On death there is only one transfer, which is a death estate at the end, if you remember from your previous lecture. I hope that you have already noted down. If you check on your notebook, I've listed just beneath the table the death estate. So that is how we calculate the death estate. We'll divide it into two things. One is the property, another is non-property. So one is personality, another one is reality. Right then. So first of all, we'll take the stocks and shares and insurance proceeds. Insurance policy proceeds. Then if you have any personal chattels, we'll have to take that. And cash as well. That's due by the deceased person. So if a deceased person has to pay something to someone else, that will be deducted. There are certain rules that what can be deducted and what cannot be deducted just beneath that. But basically there must be some consideration And if someone has promised to pay someone else, it is not sufficient because there isn't any consideration. And when I say consideration, please remember consideration from your F4 studies, whatever you studied at F4 about consideration, that's what I am referring to. Excuse me. And we'll have to deduct the funeral expenses as well. And in property section, we'll have to take the freehold property, keep UK and foreign properties separate in this section, and we'll have to deduct the mortgage from that. If any house is on mortgage, you'll have to deduct the expenses of the mortgage from that as well. Now, some of you might not be from the UK. Mortgage simply means that when you want to buy a house, you go to the bank and you say to the bank that I want to buy that house. So the bank pays to that owner, but you pay to bank in installments. So obviously bank is financing you. They will charge some interest on that. So you will be eventual owner and you will be living in the house as well. So it is basically better than paying the rent. So eventually you're just paying the rent, but you will be the owner of the house eventually. Right then, after deducting the mortgage, it is called net estate, and we'll have to add gift with reservation as well. We will read later what the gift with reservation is. Gift with reservation simply means that when I have made a gift to someone else, but I still live in that house, so I keep the reservation while I give the gift. If I do like that, that will be included in the death estate, and the net amount is going to be our chargeable estate. Now these are the expenses and funeral expenses and debts. These are the things which can be deducted. Please read it yourself. All of them are just the basic things. And on page 72 of your lecture notes, it says death tax on death estate, how to calculate the death tax. Right? Now it is almost exactly the same way like we did in our lifetime. It is just simple. In order to calculate, we'll have to follow these steps. Look back 7 years from the date of death. In lifetime tax, we have to look from look back 7 years from the date of the transfer of the gift, whereas we will look from the date of the death here, to see if any CLTs and pets which have become chargeable have been made. If so, these will use the nil rate band, and any remaining, if you have any remaining nil rate band, up to that you have to pay at the rate of 0%, and on excess of that you have to pay at the death rate of 40%. Right? And after that it says deduct relevant reliefs from the death tax, and it says quick cession relief. There isn't any quick cession relief. There is quick succession relief. We will read later. I haven't put it in our notes, these notes, but I will share a small page with you, which you can download when we do the relevant section. I will tell you at that time. But it is just a small topic, a quick succession relief. Right? Then it says a transfer of unused nil rate band. Now say for example, if Mr. A and Mr. B, Mr. A and Mrs. A, right? So they were living together and they were old persons. Now Mr. A died. Now when Mr. A died, after calculating the tax liabilities, after calculating the inheritance tax, there was still some nil rate band remained even after deducting everything. So it is called unused nil rate band of Mr. A. Now when his wife will die, so the personal representative of his wife will have 325,000 pounds of nil rate band of Mr. Mrs. A, and that unused nil rate band of her spouse will also be added in that. Right? So that's what it says in the notes as well. So we'll read the notes, then you will understand it in a better way. If a person who has died had a spouse who died earlier with any unused band on his or her death, then nil rate band on the later death will be increased by the percentage of the nil rate band of the earlier death. Right? So it will be basically a percentage. Now if I'll just say that Mr. and Mrs. So if Mr. died earlier and he had 300,000 pounds worth of nil rate band, but he only used £200,000. So 100,000 still remained. So we'll take how much is this 100,000 of total of that nil rate band. So whatever the percentage is, we'll have to take that. We'll have to apply that percentage to the new nil rate band of Mrs. And then we'll have to add that into the Mrs. nil rate band, right? So we'll have two nil rate bands. One is unused one, and other one is the new one. So for example, the nil rate band at B's death was £300,000, and B had an unused annual nil rate band of £30,000. Then the unused portion is 10%. So if A dies, then the nil rate band changed to £325,000. Then B's unused nil rate band is going to be 10% of £325,000, which is 32,500. So they will get 325,000 for himself or herself, and on top of that her spouse as well, whatever the percentage was. In this case it is 10%, right? The next rule is called grossing up gift on death. Now say for example, if anything is left in the will, now when anything is left in the will, then they will have to pay tax on death, right? Now sometimes what happens is that what individual does is that they will say, I will transfer this thing to my son, that thing to my daughter, and the remaining thing to my wife, right? Now when wording is like that, remaining thing to my wife, or remaining thing to the charity, or remaining thing to the political party, I think you're getting it. What I am pointing out is all different exempt parties. Remember, there were 4 different exempt parties. So when someone does like that, when transferred to the exempt parties, then we'll have to gross it up, right? So that's what it says in the notes. How to gross it up, we'll see in the notes now. So the value of UK death estate may be grossed up on a death before computing death tax, when UK death estate is transferred to chargeable persons and the residue is left to the exempt recipient. So what he is doing is he is saying that I will give this property to my son, that property to my daughter, and the remaining amount to my wife. Now wife is exempt party. Now if he is giving the remaining residual amount to the exempt party or the political party or the charity or for national purposes, then we'll have to gross up that amount. How will we gross up? Chargeable amount in excess of the nil rate band multiplied by 40 over 60. That is the way we gross it up, right? Now if proportion of the UK death estate is transferred to spouse and other exempt chargeable persons, and then the residue is left to the chargeable persons, then there isn't any grossing up needed. So if it is other way around, then there isn't any grossing up needed. Say for example, if he said that I will give this property to my wife and the remaining property half and half between my daughter and the son, then there won't be any grossing up needed. Then it says reduce inheritance tax. Now say for example, if someone has said that I will transfer 10% of my estate to the charity, maybe 10% or more than 10%, then a reduced rate will be applied on his death estate, which is 36%. So normal 40% won't apply, whereas 36% of the rate will apply. So that's what it says in the notes. If 10% or more of the net death estate is left to the charity, then death tax rate and death estate is reduced at the rate of 36% instead of the 40%. Now when I say net death estate, what does it mean? It tells you in the bracket. So we'll take the assets less liabilities, less exemptions, less any reliefs, less any available nil rate band, and then but before charity exemption itself. So we'll have to deduct all of these things but before charity itself, and that is called a net death estate. And if 10% of that is transferred, if 10% of that is transferred to a charity, then a reduced rate of tax will apply. Excuse me. Right, on page number 73 it says gift with reservation. That is our last topic of this lecture. So I told you earlier as well, gift with reservation means that if I have made a gift but I still continue to live in that property, although I have made the gift to my son but I continue to live in my property, that is called a gift with reservation. So if I do so, so that will not be considered as potentially exempt transfer, because normally if there is transfer from one individual to another individual, it is called potentially exempt transfer. Whereas if I made the gift to my son or to other individual, and I continue to live in that property, then it will be gift with reservation. So it will not be a pet, it will be included in my death estate. Alright. Likewise, if I have some shares and I transfer the shares to my son, but I will be still getting some benefits of them shares in the shape of dividends, say for example, then in them cases as well, I will be the owner of the shares. It won't be a pet, it will be included in my death estate. Alright. Unless there are some exceptions, unless if I pay some rent to my son, if I'm living in that house, for example, if I transfer to my son but I continue to live in it, but I pay market rent, then gift with reservation won't apply. And another thing is that if there was unforeseen circumstances, so when I made the gift, I wasn't aware at that time that I will become ill or something like that. Say for example, if I made the gift to my son, so I wasn't living in that house, I lived in another house. But because I was so ill that I had to come back to this house so that my son can look after me, in them cases, gift with reservation won't apply, so it will be considered as potentially exempt transfer that time, right? Another thing is as well, now say for example, if I made the gift to my son and I continue to live in that, and after some time, I ceased living in that house. Now the day I ceased living in that house, that will be the day when it will be considered as making the pet to my son, not the actual date when I give a gift to my son, right? So it will be the day I ceased living in that house, that will be the day which will be considered as potentially exempt transfer. Right? So these are the things which it says in the gift with reservation. So it says there are rules to prevent the avoidance of inheritance tax by making the gift while reserving some benefits. The obvious example is a gift of a home and you continue to live in that. And after that, in the second paragraph, it says where a gift with reservation is made, it is treated in the same way as other gift when it was made. However, the special rules on death of the donor applies. If a reservation still exists at the date of the donor's death, the asset is included in the donor's estate at its value at the time of the death, not the value at the time of the gift, but the value at the time of the death. I hope when I say at the time of death, because it is a property, we know that it will appreciate in the value by the time. So by the time at the time when he gave the gift, its value might be less than when it is at the time of death, right? And after that it says if a reservation ceases within 7 years before death, then the gift is treated as pet made at the time the reservation ceased. Annual exemption cannot be deducted out of this out of this potential exempt transfer. And there are a few exceptions to these rules as well. I've already told you about the exceptions anyway. So you can read it yourself. Alright, so that's it for this lecture, and we will continue with inheritance tax in our next video while I take some break, and I will see you in the next video and we will continue with IHT. Thank you very much and goodbye.